Hey everyone, thanks for joining today's webinar on the paid family and medical leave business credit. My name is Brian Doolin. I'm a principal at BD Consultants. We specialize in state and local business tax as well as credits and incentives. Today we're going to go over a summary of the credit and what has changed under the new rules that were published by the One Big Beautiful Bill Act. This is a commonly overlooked business credit. So if you haven't considered this in the past for your business, feel free to reach out to me after this presentation. The last slide will have my email and my phone number on it. So here's just a quick overview of the credit. The paid family and medical leave credit is a general business tax credit for employers that provide paid family and medical leave. The credit amount can range between 12.5% to 25% of the qualified amount of paid family and medical leave wages that you paid during the tax year. It applies to qualified paid family and medical leave wages that were paid after December 31st, 2017. This credit, which was originally set to expire on January 1st of 2026, was made permanent by the OBBBA. So first, we're going to talk about the employer requirements. There's two pieces to this credit. There's the employer requirements and what you need as an employer to qualify for the credit. And then there's going to be an employee requirement on which employees qualify that you paid family and medical leave wages to during the year. So on the employer side, the employer must have a written paid leave policy that meets these two requirements below. The policy needs to provide at least 2 weeks of paid family and medical leave annually for the full-time employees and a certain prorated amount for part-times, which we won't get into in too much detail. I'm happy to talk with you later on. Also, when the paid family and medical leave wages are paid to the employee, the wage rate must be at least 50% of their normal wage rate. What sort of activities qualify as, excuse me, family and medical leave? So these are all the activities that are recognized as qualified leave. If you leave due to the birth, adoption, or foster care of a child, placement of a child with the employee for adoption or foster care, care for a spouse, child, or parent with a serious health condition, or the employee's own serious health condition, which make them unable to perform their job functions. And there's also leave for qualifying military related leave. So next we'll get into what or who is deemed to be a qualified employee. So once you meet the qualified employer requirements, you have the written policy in place. You provide paid family medical leave for at least 2 weeks to full-time employees, and you have that prorated amount for part-time employees. Then we go into the test of did you pay paid family medical leave wages to qualified employees? So a qualified employee for this credit would be those employees where in the year prior to receiving the leave pay, they earned less than 60% of what the IRS deems to be a highly compensated employee wage amount. So this is adjusted for inflation each year. As an example, for an employee to be qualified for the 2025 credit, they would have had to earn less than $96,000 of wages during 2024. Now, if the employee was hired part-time during 2024 in this example, then you would have to annualize their compensation. There's also a test which is based on the employment duration. So first test being the employee was under a certain wage amount in the year prior to receiving the credit or the pay, I'm sorry. The second requirement is that they were employed for a certain period of time before being paid the leave. So historically, under this credit since 2018, the employment duration requirement was having been employed at least 1 year prior to receiving the leave pay. The new change under the OBBBA is that starting in the 2026 tax year, there's only a requirement to have been employed 6 months or more in the year or in the period prior to receiving the leave pay. Historically, before the OBBBA changes, this credit was equal to an amount which was based on the calculated applicable percentage, which I mentioned earlier can range from 12.5% to 25%, multiplied by the paid family medical leave wages that were paid to qualifying employees for up to 12 weeks of leave. But then there's also a second method to calculate the credit, which is applicable starting in the 2026 tax year, which uses the applicable percentage against the insurance policy premiums paid by the employer. So when I mention taking the applicable percentage and multiplying that against the paid family and medical leave wages, let's talk about what the applicable percentage is and how it's calculated. So this is a base percentage, which starts at 12.5% of the paid family medical leave wages. But it can increase to 25%, excuse me, based on um, a tiered level of increases. So how the rules work is that after you start with 12.5% of base percentage, you can increase this by a 0.25% point increase for each percentage point by which the employee's rate of payment exceeds 50% of their normal wage rate. And we'll provide an example on the next slide of what I mean here. So let's take an employer whose written policy provides each qualifying employee with at least 4 weeks of annual paid family and medical leave at a rate of 75% of the wages normally paid by the employee. So in this example, because the rate of pay exceeds 50% by 25 percentage points, which is a 75% of the rate that they're getting during the paid leave, and the base threshold, which is 50%, since that difference is 25 percentage points, the applicable percentage that we're multiplying against the paid family and medical leave wages increases by 6.25%. Essentially, that's an increase of 25 percentage points multiplied by 0.2% for each percentage point that you exceed 50%. So the total applicable rate in this example is 18.75%. Now, if you are eligible for the credit and you claim the credit on your federal tax return, you must reduce your federal wage deduction for the credit amount, similar to how you would do it for the ERC, for the R&D credit, etc. There are certain rules. If your state or locality provides paid family and medical leave payouts to your employees. So the rules prior to January 1st of 2026 state that if the leave paid by a state or local government, or if there's leave required by a state or local law, it can't be used to determine your applicable rate. So when you're trying to determine which rate did the employee actually receive compared to their normal wage rate, you can include the pay which is paid by the state or local government or required to be paid by the state or local law to come up with that applicable rate. However, the new rules starting in 2026 do allow you to include that pay or the amount required to be paid by the state or locality in determining the applicable rate. For all tax years, you still can't calculate the credit using wages that were paid by the state or locality. But there is that rule change for 2026 where you can use the state or local leave pay to determine what the applicable wage rate is. So here's an example that talks about this. So under state law, there's an employee on family and medical leave that is eligible to receive 6 weeks of benefits paid by a state insurance fund at a rate of 50% of the employee's normal wages. As the employer, your written policy provides each qualifying employee with 6 weeks of annual paid family medical leave at a rate of 30%. So the conclusion in this example to determine whether you as the employer paid at least 50% or more of the employee's wage rate, that conclusion would be that you did not, because in this example, the employer did not independently satisfy the requirement that the rate of payment be at least 50% of the wages normally paid to the employee. You can't include the percentage that was paid under the state insurance fund in this example. However, in 2026 and beyond, this example would not apply because you would be able to use that 50% that was paid by the state insurance fund to determine whether the employee received at least 50% or more of their normal rate. This slide just talks about some of the main changes made by the OBBBA. We had talked about these in previous slides, but you can see them all listed here. So the first bullet point is that it's a permanent credit, so there's no more sunset date, which was previously set for January 1st of 2026. The employee eligibility expanded, which means that the credit can now be claimed using paid family medical leave wages for employees that were employed at least 6 months of employment, or had 6 months of employment as opposed to 1 year, starting in 2026. We had just talked about how state mandated leave counts when you're determining whether the employee was paid at least 50% or more of their wage rate, of their normal wage rate. And then lastly, I'd mentioned this earlier in the presentation, there's a new option to calculate the credit, which is based on multiplying the applicable rate that you compute against the amount of insurance premiums you paid um, regarding the insurance policies. So for more details on this credit, questions, or to request a credit review, please contact me. My email is support@familyleavecredit.com. You can also reach out to me on LinkedIn as well. Thank you for joining today's webinar, and I hope to talk to you soon.